Disclaimer.
Today, Sunday, January 11th, the global financial market is holding on to a single number that you'll never hear about in the news, 356 to 1. That's how many paper promises there are for every real ounce of silver physically in storage. But tomorrow, Monday, that mathematical pyramid will start to crumble. The CME just announced a dramatic increase in margin requirements. This is not just a technical change, it's a forced move that exposes the biggest banking scam in history. The world's 8 largest banks are backed into a corner. They've sold hundreds of billions of ounces they never had. And as tomorrow's margin shock forces them to close their positions, we're on the verge of the biggest short squeeze in human history. As paper promises turn to ashes, the real metal becomes the only lifeline. Today, I'm going to show you how this 356 to 1 ratio collapse will change your financial situation forever. Time is up. Let me show you exactly how we got to this breaking point, because what happened over the past 2 weeks set the stage for the explosion coming tomorrow. December 29th started like any other Sunday night for silver traders. COMEX screens showed silver climbing toward $80 per ounce, continuing a rally that had been building for weeks. Then the Chicago Mercantile Exchange dropped a bombshell that sent shockwaves through trading desks worldwide. They announced an emergency margin requirement increase, forcing traders to put up significantly more cash to hold their silver positions. The effect was immediate and brutal. Silver plummeted from $80 to $74 an hour as leveraged positions were forced to liquidate. But here's where the story takes a disturbing turn. 48 hours later on New Year's Eve, the CME did something they hadn't done in decades. They raised margins again. A second emergency hike in the span of just 2 days. Think about what that signals. Margin increases are supposed to calm volatile markets and reduce risk. If one hike didn't work and you need another within 48 hours, you're not managing normal market volatility anymore. You're dealing with something fundamentally broken in the system itself. Most traders chalk this up to typical exchange risk management, maybe a bit overzealous given the holiday timing. Then January 2nd arrived and the real story emerged, one that exposes a fraud operating in plain sight within our precious metals markets. Physical silver dealers in Tokyo began quoting $130 per ounce for immediate delivery. Not $130 for rare collectible coins or specialty products. $130 for standard 1-ounce silver bars. The same product that COMEX futures screens were simultaneously quoting at $71. You're reading that correctly. While our official exchange in the United States was telling the world that silver trades at $71, actual buyers trying to secure physical metal in Tokyo were paying $130 for the exact same ounce. This wasn't an isolated glitch or regional premium. Dubai dealers were charging $127 per ounce. Kuwait came in at $106. Korea reported $97. Even Walmart's online precious metals partner JPMorgan was listing standard silver bars at $87, $16 above the official COMEX quote that is supposed to represent the true global price of silver. Here's the question you should be asking. How can the same commodity have wildly different prices simultaneously around the world? The answer reveals something far more troubling than simple market inefficiency. It reveals that the COMEX price is unreal. It's a paper fiction maintained by 356 claims existing for every single physical ounce actually available for delivery. Let me put that in perspective for you. Imagine walking into 356 different banks, and each one gives you a certificate saying you own the same $100 bill sitting in their vault. Everything works fine, as long as no more than 1 or 2 people at a time try to actually withdraw that bill. But what happens when 10 people show up? When 50 people demand their money? When all 356 certificate holders simultaneously realize they were sold claims to something that does not exist in the quantities promised? That's precisely what began unfolding in our silver market during the final week of December, and the evidence suggests someone very powerful nearly went under because of it. 3 days before the first margin hike, on December 26th, while most Americans were enjoying post-Christmas relaxation, the Federal Reserve executed a $17 billion emergency repurchase agreement with an unnamed bank. $17 billion deployed on a holiday week when markets are typically quiet and calm. The Fed doesn't identify which institution received this emergency liquidity injection, but the timing is impossible to ignore. 3 days later, COMEX announces unprecedented back-to-back margin hikes, specifically targeting silver positions. According to data from the Bank for International Settlements, the concentrated short position in silver futures has been dominated by just a handful of major banks for years. When a bank holds a massive short position and the underlying commodity suddenly surges in price, as silver did in late December, those losses can accumulate fast, really fast. Every dollar silver rises translates to hundreds of millions in losses. For institutions short hundreds of millions of ounces. Now, here's where it gets even more interesting. JPMorgan Chase, historically, one of the largest silver short sellers on Wall Street, and a bank that faced federal charges back in 2020 for manipulating precious metals markets, suddenly reversed course in early January. The first COMEX delivery report of 2025 showed JPMorgan standing for maximum physical delivery, meaning they are demanding actual metal be delivered to their vaults rather than rolling contracts forward or settling in cash like they've done for years. Think about what that means. The bank with perhaps the deepest inside knowledge of how the silver market actually operates, a bank that made fortunes for years betting against silver prices, abruptly switched to demanding physical metal delivery right as the paper market began showing cracks. That's not a casual trading decision. That's a strategic positioning ahead of a crisis they see coming. And the crisis accelerated precisely on schedule. While JPMorgan was reversing to take delivery, China implemented export licensing restrictions that went into effect January 1st. These aren't minor regulatory adjustments. They represent a fundamental reshaping of global silver supply chains. The new rules require Chinese silver refiners to maintain minimum production capacity of 80 tons annually just to qualify for export licenses. And the number of approved companies dropped from hundreds down to just 44. Why does this matter to you? Because China controls approximately 65% of global refined silver production. When they lock down 2/3 of the world's supply with export restrictions. In the same week that COMEX doubles margin requirements, you don't have coincidence. You have coordination, or at minimum a perfect storm that exposes just how fragile the paper silver market really is. COMEX was already struggling to deliver the 65 million ounces of silver demanded for December contract settlements. Multiple reports from trading desks indicated that some position holders were being offered cash-only settlements instead of physical metal delivery. Read that again. The exchange that's supposed to guarantee delivery of the commodity underlying futures contracts was telling people, we can't give you the silver, here's cash instead. That's not how commodity markets are supposed to function. The entire premise of futures contracts is that they're backed by deliverable physical commodities. If the exchange can't deliver the metal, the price quoted on that exchange is not reflecting the real market for silver. It's reflecting the price of an IOU that may never be honored. Shanghai maintained $8 per ounce premiums through late December, relatively modest by comparison to what we're seeing now. But the exchange for physical spread, which measures the cost of moving silver between COMEX vaults and London bullion market vaults, exploded from 25 cents to $1.10. That's institutional buyers paying massive premiums to physically relocate metal between different storage locations, because they don't trust that their paper claims in one market can actually be converted to physical delivery. What we witnessed between December 26th and January 2nd wasn't normal market volatility or even a temporary supply disruption. We witnessed the moment when the paper silver market, the 356 claims per ounce system that major banks and exchanges have maintained for decades, began to fail under the weight of actual delivery demands it was never designed to fulfill. The $17 billion Fed rescue kept someone afloat through the immediate crisis. The double margin hikes forced liquidation of leverage positions, temporarily reducing delivery pressure. But none of these actions addressed the underlying mathematical reality. There are 356 paper claims for every ounce of silver that could actually be delivered. And when people start demanding the physical metal those paper claims supposedly represent, the entire structure collapses. By February, we will know whether COMEX can maintain the fiction or whether they will be forced to admit what Tokyo, Dubai, Kuwait, and Korea are already showing us, that real silver deliverable silver trades at prices far above what our official exchanges claim. Now, let me show you exactly how deep this rabbit hole goes, because the global price discrepancies I just mentioned are not anomalies or temporary dislocations. They are the market screaming that our official price discovery mechanism has completely detached from physical reality. You want proof? Let's walk through what actual buyers around the world were paying for silver, while COMEX insisted the price was hovering around $71 to $79 through early January. Dubai dealers maintained consistent quotes of $127 per ounce for standard bars. Kuwait precious metals dealers charged $106. South Korean buyers faced $97 prices. These aren't boutique premiums for special coins or certified collectibles. These are wholesale prices for the same 1,000-ounce industrial bars that factories and manufacturers require for production. Even right here in the United States, the disconnect is impossible to ignore. Pull up Walmart's website right now and check their precious metals section powered by AppMax, one of the country's largest bullion dealers. You'll find standard 1-ounce silver bars listed at $87. That's not some niche dealer in a back alley. That's Walmart, selling to everyday Americans at $16 above what our futures exchange claims silver is worth. Think about what you're witnessing here. Imagine if Ford dealerships nationwide were selling F-150 trucks for $60,000 while the official automotive pricing index insisted F-150s only cost $43,000. You'd immediately know something was fundamentally broken in how that index calculates prices. That's exactly what's happening in our silver market, except the stakes are far higher because this is not about truck prices. This is about the integrity of our commodity markets and the wealth millions of Americans believe they hold in precious metals investments. Shanghai's price action tells an even more revealing story. According to data from the Shanghai Gold Exchange, physical silver premiums held at $8 per ounce through late December, modest by Asian standards. But significant because Shanghai premiums typically indicate how desperate Chinese industrial buyers are to secure supply. When Shanghai premiums spike above $5, it historically signals that domestic Chinese demand is outstripping immediately available supply. But here's what should grab your attention. Those $8 premiums existed before the January 1st export restrictions kicked in. The exchange for physical spread, and I need you to understand what this metric actually measures, jumped from 25 cents to $1.10 in a matter of days. This spread represents the cost institutional investors pay to physically move silver between COMEX vaults in the United States and London bullion market vaults in the UK. Under normal market conditions, this spread stays tight because silver should have roughly the same value, whether it's sitting in a vault in New York or a vault in London, minus minimal transportation and insurance costs. When that spread explodes to $1.10, you're watching institutional investors, the sophisticated money managing billions in assets, pay massive premiums simply to relocate metal from one vault system to another. Why would they do that? Because they fundamentally don't trust that their paper claims in the COMEX system can be converted to actual deliverable metal when they need it. They're paying $1.10 per ounce, multiplied across millions of ounces, purely for the security of having physical silver in vaults they trust. Now, let's talk about what's actually available to deliver at COMEX, because this is where the mathematics become impossible to ignore. COMEX registered inventory, silver that's actually available for delivery against futures contracts, has collapsed 70% since 2020. We went from 346 million ounces in registered inventory down to 82 million ounces by late 2023, and that number has continued declining into 2025. To put 82 million ounces in perspective, December contracts alone demanded delivery of 65 million ounces. You're watching a single month's delivery requests consume nearly 80% of total registered inventory. And remember, those 65 million ounces represent just the December contracts, where holders insisted on taking physical delivery rather than rolling forward or settling in cash. How many additional contracts exist where holders haven't demanded delivery yet but legally could? The December 2nd commitment of traders report from the Commodity Futures Trading Commission revealed that banks collectively held net short positions of 212 million ounces. Let me make sure you grasp what that means for the banks involved. Every single dollar that silver rises costs these institutions $180 million in losses. When silver rallied from $60 to $80 in late December, those banks were underwater for $3.6 billion on their short positions. But here's the truly terrifying part for anyone short this market. They can't cover those positions, even if they wanted to, because the physical metal doesn't exist in quantities sufficient to buy back 212 million ounces. According to the Silver Institute's annual supply and demand report, total global silver production in 2024 was approximately 1 billion ounces. The banks are collectively short more than 20% of annual global production, and they're short against a backdrop where available inventory has collapsed and industrial demand is absolutely relentless. China just made the situation exponentially worse. On January 1st, the State Securities Times, an official government publication, formally upgraded silver to strategic resource status. This isn't symbolic bureaucratic language. Strategic resource classification in China means the government views silver as essential to national industrial capacity and technological advancement, equivalent to rare earth elements or semiconductor materials. They are not hiding their intentions anymore. They're openly weaponizing supply against Western industrial users who depend on consistent silver availability. The export licensing I mentioned earlier is not a temporary policy that will be revisited in a few months. China's State Council announced these restrictions will run through at minimum 2027, and they reduced the number of approved export companies from hundreds down to just 44. Those 44 companies must maintain minimum annual production capacity of 80 tons and meet stringent quality and strategic cooperation requirements. What China is effectively telling the world is that silver flowing out of their refineries, representing 65% of global refined supply, will now flow according to their strategic priorities, not market demand. Have you noticed what's different about this crisis compared to previous silver price spikes? In 1980, the Hunt brothers tried to corner the silver market through massive speculative buying. When exchanges raised margins, speculative longs were forced to liquidate, prices collapsed, and the market returned to normal because industrial demand was flexible. Factories could reduce silver usage or substitute alternatives when prices spiked. In April 2011, silver rocketed to $49 per ounce, driven largely by investment speculation following the financial crisis. Exchanges raised margins, speculative positions unwound, and again prices declined because the buying pressure was primarily from investors who could simply choose not to buy if prices went too high. But this time is mathematically different. According to research from Metals Focus, a leading precious metals consultancy, industrial applications consumed 60% of total silver production in 2025. Artificial intelligence hardware manufacturing requires silver for high-performance circuit boards and thermal management systems. Solar panel production uses silver paste for photovoltaic cell electrical contacts, with no economically viable substitute material that matches silver's conductivity and reliability. Advanced medical devices, 5G infrastructure, electric vehicle charging systems, these aren't discretionary uses where buyers can simply walk away if prices rise. When a semiconductor fabrication plant needs silver to maintain production, they pay whatever price is necessary because shutting down the fab costs millions of dollars per day in lost output and potentially damages sensitive manufacturing equipment. When a solar panel manufacturer has contracts to deliver panels at fixed prices, they'll pay enormous silver premiums to avoid contract penalties that would dwarf their silver input costs. This is price-inelastic demand, buyers who have no choice but to pay market prices, regardless of how high those prices climb. And here's the data point that should terrify anyone holding paper silver, expecting to convert it to physical metal. We're in a 7-year cumulative deficit totaling 800 million ounces. That means for 7 consecutive years, annual global demand for silver has exceeded annual supply by an average of 114 million ounces per year. The Silver Institute projects this deficit will continue through at least 2026. Where did that 800 million ounce deficit come from? It came from drawdowns of existing above-ground inventory, silver that was already refined and sitting in vaults or available stockpiles. We've been eating our seed corn, consuming inventory that took decades to accumulate. And now with China locking down 65% of refined supply and industrial demand, continuing to grow the shorts, holding 212 million ounces in net short positions, but can't physically buy back the metal they owe, even if silver hits $200 per ounce. Think about your own portfolio for a moment. If you own shares in a silver ETF like SLV, do you know whether your shares represent actual metal in a vault or contractual promise to deliver metal that may not exist? If you hold COMEX silver futures expecting to take delivery, have you confirmed that registered inventory will be available when your contract comes due? Because what we're watching unfold right now is the moment when 356 paper claims are discovering they can't all convert to the single physical ounce they supposedly represent. The margin hikes, the Fed's emergency $17 billion repo, JPMorgan's sudden reversal to taking delivery, China's export restrictions, the global price discrepancies, these aren't isolated events. They're all symptoms of the same underlying disease. A paper market that created far more claims to silver than physical silver exists to satisfy those claims, and industrial demand that won't stop no matter how high prices rise. What happens next isn't a question of if the system breaks, but when the break becomes undeniable to everyone watching. So let's do the math that Wall Street desperately hopes you never do. Because once you see these numbers, you'll understand why Monday's margin shock is just the opening move in a crisis that ends with either complete market collapse or the most violent repricing in commodity history. January 28th is your deadline. That's when the current round of COMEX contracts reaches final delivery. Between now and then, the exchange faces a binary outcome with no middle ground. Either they admit the paper system failed or they somehow conjure physical metal that doesn't exist in sufficient quantities. Option 1. COMEX declares force majeure. That's the legal term for we cannot fulfill our contractual obligations due to circumstances beyond our control. It's the official admission that the futures contracts they've been selling can't be honored with physical delivery. If this happens, we'll see a permanent split between paper and physical markets. COMEX screens might show silver at $50 to $70 per ounce, while actual metal trades for $120 to $150 in physical markets from Tokyo to Dubai to London. Think about what that means for your investments. If you're holding shares in SLV or any silver ETF believing you own silver, you'd suddenly discover you own a claim to a COMEX price that is half of what real silver costs. If you're holding futures contracts expecting to convert them to physical metal, you'd learn those contracts will be forcibly cash settled at the fictional paper price, while anyone with actual metal in their possession watches its value double or triple. Option 2, the shorts capitulate. With banks collectively short 212 million ounces and unable to buy back even a fraction of that volume without driving prices exponentially higher, capitulation means vertical repricing. Bank of America. Its commodity research desk published projections ranging from $135 per ounce in a moderate squeeze scenario to $309 per ounce if industrial buyers panic and start hoarding supply. These aren't fringe analyst predictions. This is Bank of America, one of the 8 major banks deep in the short side of this trade, telling their clients what mathematical price targets look like if the squeeze accelerates. But here's the part that should keep you awake tonight. Both scenarios destroy 355 out of every 356 paper claim holders. Whether COMEX admits failure or whether shorts drive prices to $300, the overwhelming majority of people holding paper promises to silver will discover those promises can't be converted to actual metal. The mathematics are inescapable. You cannot have 356 claims and only one deliverable ounce and somehow satisfy more than one claimant. Have you checked whether your silver holdings are paper or physical? Because if you haven't already secured actual metal in your possession or in allocated storage, where you have legal title to specific bars with serial numbers, you are statistically likely to be one of the 355 who discovers their claim was worthless when everyone else tries to claim the same ounce. Now let's talk about why this crisis can't be resolved by simply producing more silver, because the timeline to increase supply makes current shortages essentially permanent for the next several years. China's export licensing does not expire in a few months. It runs through minimum 2027, according to the State Council announcement. That means the 65% of global refined supply they control will flow according to their strategic priorities for at least the next 2 years, probably longer. What about ramping up mining production? According to the Silver Institute, developing a new silver mine from exploration to production takes 8 to 12 years, even when prices provide strong incentive. These aren't projects you can accelerate by throwing money at them. You need to discover ore bodies, conduct feasibility studies, secure environmental permits, raise capital, build processing infrastructure, and only then begin extracting ore. Even if silver hits $200 per ounce tomorrow, new supply won't reach the market until the early 2030s. The structural deficit continues regardless of price. This is the 5th consecutive year where annual demand exceeds annual supply. And unlike previous deficit periods where high prices eventually destroyed demand, industrial applications in 2025 are non-negotiable. According to Metals Focus research, artificial intelligence hardware production is expected to double over the next 18 months. Solar panel manufacturing continues expanding as governments worldwide push renewable energy mandates. Electric vehicle charging infrastructure build-outs require silver for electrical contact points and circuit components. You can't build an AI training cluster without silver. You can't manufacture solar panels without silver. You can't deploy 5G infrastructure without silver. And critically, you can't substitute alternative materials that match silver's unique combination of electrical conductivity, thermal management, and reliability in high-performance applications. When demand is truly price inelastic because buyers have no alternatives, prices rise until they find the level where marginal buyers finally drop out. But in markets where virtually all buyers are industrial with no substitution options, that price level could be multiples of where we are today. So when Tokyo dealers quote $130 per ounce and Dubai charges $127, while COMEX screens show $79, what you're actually witnessing isn't inflated premiums in physical markets. You're witnessing honest price discovery for actual metal versus accounting fiction maintained by derivatives desks and banks desperately hoping to delay the day of reckoning. COMEX, $79 quote, represents the price at which contracts change hands between speculators who never intend to take delivery. It's the price of a promise, an IOU, a derivative contract that derives its value from silver but isn't itself silver. Tokyo's $130 quote represents the price someone pays when they need actual metal delivered to their vault or their factory floor, when the rubber meets the road and promises must convert to physical reality. The margin hikes that started this crisis weren't risk management protocols designed to reduce volatility. They were desperation moves by an exchange that saw delivery demands they couldn't fulfill. The Chicago Mercantile Exchange watched December contracts demanding 65 million ounces against registered inventory of 82 million ounces and realized that if delivery demands continued at that pace, they'd run out of deliverable metal within 2 or 3 more contract months. Remember that $17 billion Federal Reserve emergency repo on December 26th? That wasn't routine liquidity provision during a holiday week. That was the Fed bailing out an unnamed institution that faced imminent failure due to their silver short position losses. When you need $17 billion deployed on emergency basis 3 days before Christmas, you're not dealing with typical market turbulence. You're dealing with a systemically important financial institution on the brink of collapse. and JPMorgan's reversal to standing for maximum physical delivery. Jamie Dimon and his trading desk heads aren't suddenly bullish on silver because they believe in its long-term prospects. They're grabbing physical metal because they know what's coming. JPMorgan has the best inside view of commodity market positioning in the world. They see the concentration of shorts. They know which institutions are vulnerable. They understand that when delivery demands exceed available supply, whoever holds actual metal wins, while everyone holding paper promises loses everything. By February, one of two things happens. Either COMEX finds some way to satisfy delivery demands, which seems mathematically impossible given current inventory levels and ongoing deficit, or they're forced to admit they can't deliver metal at the prices their contracts specify. There's no third option where everything continues normally and this crisis just fades away. Monday's margin shock is the beginning, not the end. As margin requirements rise, over-leveraged positions are forced to liquidate, which temporarily reduces delivery pressure, but also reveals just how fragile the entire structure really is. If one margin hike doesn't stabilize the market and a second one proves necessary within 48 hours, what do you think happens when that second hike also fails to prevent delivery demands from overwhelming available supply? The 356-to-1 ratio can't be maintained when even a small percentage of claim holders demand their ounce. That's the mathematical trap that's closing on this market. As more people understand that paper and physical have diverged permanently, the scramble to convert paper claims into actual metal accelerates, which drives the divergence even wider, which creates more panic, which accelerates the scramble further. It's a self-reinforcing cycle that ends with the complete breakdown of the paper market and a repricing that reflects true scarcity of deliverable metal. You now understand something that most investors holding silver exposure don't know and won't know until it's too late to act. 356 claims exist for every ounce. Delivery demands are overwhelming available supply. China has locked down 65% of global refined production. Industrial buyers can't stop buying regardless of price. And Wall Street, as most sophisticated traders, are quietly shifting from paper to physical while there's still time. What you do with this information is your decision to make. But understand that the decision itself has a deadline. Once the divergence between paper and physical prices becomes obvious to everyone, the window to convert paper claims to actual metal closes permanently. We're not talking about months from now. We're talking about weeks, possibly days. The 356-to-1 trap is closing. Time is up.